If you're thinking about moving to Bellingham, Washington, it's helpful to get a sense of what it would look like to buy a house there, and specifically what your numbers would be, how much your monthly payment might be, and what your options are as far as buying a house. So we're going to look at this house in Bellingham, which is listed at $650,000, and we're going to walk through a real mortgage quote, to talk about what your monthly payment would look like on this place. And then we'll also get a chance to look at how much cash you would need to bring all into the deal with your down payment and your closing costs. And then we'll talk about how much income it would take to qualify for the loan. So what we'll do is we'll look at two different scenarios. One where you have a down payment of 10% down, and one where you have a 25% down payment on the house. And so we'll walk through the numbers for each of those scenarios, and hopefully that'll give you a sense of what your numbers might look like on that house in a more reliable way than you might be able to find just on Zillow on an online calculator. And it will also give you a little bit of information behind why the numbers are what they are and what to really expect going forward. So this is a real mortgage quote that we're going to look at. My name is Landon Buto. I work with Cleveland Street Mortgage, a mortgage broker based in Bothell, Washington. So it is a real quote we're pulling on the house, but that doesn't mean it's going to be the exact numbers that you will see. It's not going to be the exact interest rate that you will get. None of this is an advertisement for the exact numbers you will get, but it should give you a good idea of what to expect going into the process. All right, so here are the two quotes, and on the right is the 10% down scenario, and on the left is the 25% down scenario. And for both of these, I'm assuming a credit score of 740. So obviously that's going to impact your pricing. If you're in the 700s, if you're relatively close to this, yes, it will vary. If you make it to 760, it's going to be better if you make it to 780, and so on. And if you're below that, if you're below 740, if you're below 720, it changes in 20-point increments typically, your pricing. So yes, it will be different, but if you're in the 700s, this should be reasonably close and won't have a massive impact in terms of what the actual numbers look like. If you start to get below the 700s and into the 600s, then it will have a more significant impact. But either way, as we walk through this and you know that the credit score is 740, it should give you a realistic idea of what the numbers might look like and how the numbers change based on various factors in your mortgage setup. And so hopefully this will be helpful regardless. And again, as we're walking through, I'm going to start with this 10% down scenario here, and then we're going to walk through the 25% scenario and see how the numbers change and why they are different. And even if you're more like 3% down or 5% down, or if you're more like 50% down, hopefully seeing the difference between these two and talking about why the numbers are different, you'll be able to just apply that to your situation as well. And factor in those differences there. So let's walk through the numbers for the 10% down. You can see right away the monthly payment is $4,643, and there are four main components that are going into this total monthly payment of $4,643. The first one is homeowners insurance of $150 per month. That's an estimate. You might be somewhere. This will vary a lot. It will vary depending on who your provider is, who your insurance provider is, and what your coverage is. So this will vary a good amount, but this is a pretty good number to expect in our area and at this purchase price, at this price point. That should be a pretty good number to expect, so that's what we're using. That's a pretty common number that we see for this kind of price point in our area. The taxes here are $351 per month, and that is drawn from the county website for this house specifically for 2024. So that is based on the actual number for 2024, $351 per month. The next component here is mortgage insurance, which is $102 per month. Now, mortgage insurance is something you have to pay if you put less than 20% down on a house. You have to pay it in order to protect the lender against the chance of default. That's kind of a universal thing. Any lender, anywhere, that you're going to end up paying mortgage insurance if you put less than 20% down. Now, there are probably some rare, random exceptions to that, but if they're not doing that, typically their pricing, that means they're not conforming to Fannie and Freddie standards, which are the big lenders that buy these loans on the back end. And if they don't conform to Fannie and Freddie standards, it's going to be hard to offer really good pricing. So maybe you can find a lender that's not going to do mortgage insurance below 20%. but their overall pricing and offering is probably going to be pretty limited and not great. Maybe higher interest rates, things like that. So mortgage insurance of $102 per month, and again, that can vary depending on several factors. One of those factors is just your down payment percentage. If we had put less, if we had put 5% down, that number could be a good bit higher. If we made it to 15% down, that number could drop down a lot to as low as $30-$40 a month. Another big impactful factor is just the loan amount. If we had a loan amount of $400,000 rather than $585,000, then that mortgage insurance number would drop down a good bit as well. This is a pretty high loan amount. So $102 per month. That's also dependent on your credit score. If you had a lower credit score, if you had a lower down payment percentage, if you had a larger loan amount, any of those things, that number could be as high as $200 to $300 a month. So just to give you an idea of how that could vary. And then the last component is $4,040 of principal and interest, and all that added together makes your total monthly payment. The principal and interest here is based on your loan amount of $585,000 and your interest rate of 7.375%. Now, I'm making this here nearing the end of April 22nd, and this is what we're seeing right now. Again, these interest rates are changing every week right now, and so don't know what to expect going forward, but this is a pretty good idea of where we're at right now. That it will depend on your down payment percentage, on your credit score, and several factors, but just by and large for this kind of scenario where you are conventional conforming, 30-year, credit score in the 700s, this is roughly what we're seeing right now of 7.375. This just means monthly payment. That's just showing your monthly payment, not including the taxes and the insurance. Now, the taxes and the insurance will be included in your monthly payment, but the reason they're showing it here is those are not affected by your loan structure. Those are not really part of the mortgage side in a sense, even though you do include them in your mortgage payment. And so it's just showing your monthly payment apart from those things. Points or credit, we're showing $731 of credit, and credit is anytime you get a loan, you have to technically choose an interest rate, and your choice is based on it's against the par rate, which the par rate is 0 points. If you're not paying any points, you're not taking any credit, what is the standard rate? However, you could take a higher rate and take a credit from the lender. If you take a higher rate, the lender will credit you towards your closing costs, some cash. In this case, we're taking $730 of credit towards our closing costs in order to take this rate. Whereas points are where you pay cash up front to the lender in order to get a lower rate. So you could drop this down to, let's say, 7% for a few $1,000s in points. Now, why is this 731? This number, this is pretty much as close to zero as we're going to see. When you get a quote, go to get your actual mortgage, most lenders will actually not let you have a 0 point option, an exact rate option. This particular lender does. So it's pretty uncommon to have 0 points, and I'm not going to get into explaining why at the moment. But at the very least, when you get a mortgage quote, you're going to see some level of a few $100 one direction or the other, because your rates are typically just priced on eighth increments, so 7%, 7.125, 7.25, 7.375, and then they show a corresponding amount of points or credit with that. So that's why we're seeing 731 here. But that is not really having much of an impact on the interest rate. It would take several $1,000s for a loan amount of this price point in the market we're in right now. It would take several $1,000s to move the needle on this interest rate, so it's not really moving the needle at all for $730. 30-day lock. When you get your interest rate, you have to lock your You have to lock that rate, and it expires after a certain point based on how long you're locking it for, if you don't close the loan but within this timeline from when you lock it to when you get the interest rate. So typically after you go into contract on a house, you'll lock it then, and then you have however long you locked it for. Typical windows are 30, 45 days, 60 days, 90 days, but 30 days is typically all you need. It would be a rare situation if you need to, not rare, but less than standard if you need more than a 30-day lock. Prepayment penalty, no prepayment penalty for paying off your loan early. Lender fees, $1,195. Most times you'll see some amount of lender fees. Just make sure those aren't getting crazy high. Watch out for that. But this is pretty typical to just cover basic costs that the lender incurs and pay the parties from the actual lending company. Now, we broker to a lender. We are a mortgage broker. We broker to a lender. So these are going to the lender, not to us. Other closing costs, $10,109. Those typically closing costs include two main components. One component is just when you get a house, you have to pay all the people and the services that have to be involved in order to help you get the house and get the loan. You have to pay the title and the escrow company. You have to pay the loan officer. You have to pay for an appraisal, for an inspection. And so all those are going into here. And then the other component is what's called prepaids, which are costs you're just going to be paying on an ongoing basis. You have to put your taxes and your insurance into escrow ahead of time for a few months typically. You have to pay some prepaid interest. So those are costs you're just going to be paying on an ongoing basis as part of your monthly payment. But you have to put some of them into escrow ahead of time in order to get them taken care of while you're still getting set up with your monthly payments, basically. So those are the two main components that go into closing costs. And for this price point, for this loan amount, we typically estimate around $10,000 to $12,000. If you get above that in price point or loan amount, if you're getting significantly above either of these, if you're close to $1 million in purchase price or close to $700,000 in loan amount, then this number might go up to closer to $13,000 to $15,000. But those are just rough estimates. Right now on this particular one, we're seeing $10,000 of closing costs. So when you add your 10% down payment plus your $10,000 of closing costs, the total cash to close, the total cash you're going to need to bring and put into escrow in order to get this house and close this deal is $76,304. Okay. So let's walk through the 25% down and see how it's impacted, see how the pricing is different, the numbers are different by getting the 25% down. Right away you can see your monthly payment is $3,868, which is just a little bit below $1,000 lower than your monthly payment over here. The differences here, one of the key differences is we no longer have mortgage insurance because we got to 20% down. So we don't have to pay mortgage insurance when you get to 20% down. So that means the three components here are homeowners insurance and taxes. Those are both going to be the same because they're dependent on the house. They're not affected by changing the loan structure. So $150 per month, $351 per month. And then principal and interest of $3367, which again is based on your loan amount, which is now $487,500, and your interest rate 7.375. Again, monthly payment. This is just showing without the homeowners insurance or taxes. It's just your principal and interest, which is $3367. Points or credit. Now, in order to get this interest rate, it took slightly. We took a slightly lower credit of 609 to get this interest rate. So that'll just, the points or credit that it takes to get a certain rate will change depending on your overall loan structure, and one of those components is your down payment. 30-day lock period, again, no prepayment penalty, same lender fees, other closing costs still around $10,000. So what that means is your closing costs of $10,000 plus your down payment of 25% equals $173,729 of cash that you're going to have to bring all in to escrow to close this deal. So how much income would it take to qualify for this loan? Now, when I talk about this, I am not talking about what you should budget for. I'm not talking about how much of your monthly income you should dedicate to your housing payment. I'm not talking about should. I'm not talking about budgeting. I'm not talking about what you could afford. I'm talking about what you could qualify for, meaning if you came to the lender, would they approve you for the loan based on X amount of income? If you came to the lender and you had $100,000 of income, would they approve you for this scenario? Would they approve you for this scenario? How do they figure that out? So the way that the lenders evaluate that, and the rule that I'm about to give is specifically true of conventional loans, and it's very similar with FHA. It's slightly different, but it's very similar with FHA loans. With VA loans, USDA loans, the way that they calculate it is pretty different. But with conventional, the way that they figure out is they look at your debt to income ratio, your DTI. And your DTI needs to be, your DTI, the calculation is your total monthly debts divided by your gross monthly income. And this number needs to be less than 50% in order to qualify. If it is less than 50%, typically the lender will approve you for the loan. So what is this number? It's your total monthly debts, which is your new proposed housing payment that you're trying to take on. So they take this number and that would result from your housing payment, and then they add it to any other monthly debts you have, your student loan debt, car debt, any other monthly debts. They add that all together, and then they divide it by your gross monthly income, and they see if it's less than 50%. So it's pretty straightforward to figure out what that equation is once you know this number. But this number is sometimes hard to figure out because if you're salaried, then it's pretty straightforward. They can typically just use your whole salary, barring a few unusual circumstances. Then your salary is pretty much usually entirely usable. But any other type of pay structure, if you're paid in commission, if you work variable hours, if you are self-employed, if you're paid in stock, any other type of pay structure or compensation is sometimes pretty difficult to figure out and has to meet certain rules in order to be included in this number down here. However, if it does meet those rules, whatever of that is included, you can look into that. You can research how certain income is usable, but it is very confusing and it's always changing, and it's just dependent on many things. So the best way to figure out that if you do have this kind of pay structure, if you have those different kind of pay structures, is to just talk to a loan officer. So do feel free to reach out for that. Just send us a text, an email, give us a call, whatever. Do feel free to reach out because it's difficult to figure out this number on your own. The way that lenders figure out what this number is the way that you're going to have to use in the end of the day in order to qualify. And so I'd encourage you just to reach out and ask, talk to us, talk to another loan officer, and start to get that figured out. But whatever that number they end up using down here, as long as your total monthly debts divided by your gross monthly income is less than 50%, then you're pretty much good to go. So let's look at whether you'll be able to qualify for these loans. What income would it take to qualify for these loans? It's going to be a different number in each scenario because it's dependent on this monthly payment. So in this scenario, I'm going to assuming you have no other monthly debts, I'm going to figure out what your gross monthly income would need to be in order to qualify for these loans. In this scenario, $3,868, it would have to be $7,736. I think I'll come back and check that. $7,736 per month, and this one you'd have to be making $9,286 per month. I'll come back and check that as well. But basically twice this. Assuming you have no other debt, you'd have to be making more than twice this. If you're making less than twice this, then you would not be able to take this on. Anything more than twice this payment, then you'd be pretty much good to go, because that would put you below 50% debt to income ratio. Now again, that's assuming that all of the income that you are making is usable in this number. And again, that is for qualifying. It's not for budgeting or affordability. So let me check those, and I'll show the annual income that would be too. Okay, so it would be $77.36 per month for this one to be able to take that on, and per year that would be $92,832, and this one per year would be $111,432 per year in order to qualify for this monthly payment. If you want to get a look at a house you are looking at, if you'd like a mortgage quote on that house, if you want to get a look at your income to see how much house you could qualify for, or if you just are interested in asking questions, please do reach out. All of our contact information is in the description below. We are a mortgage broker based in Bothell, Washington, and we do loans in Washington and Idaho, and we'd love to work with you. We love working with new clients, so please do reach out using any of the contact information in the description below.